Hi, my name is Toxie, and I'm the president of Evergreen Anchor Capital. Welcome to another episode in our series titled My Not So Crazy Mortgage, aimed at helping you get prepared for your next mortgage loan. That way, you can get the best options, the best interest rates, and have the best mortgage experience during the process. Today, we're going to be answering the question on what exactly goes into my mortgage payment. So, what goes into your mortgage payment? Well, there are potentially five things. The first and second things are combined together, and that's your principal and interest. Why are they tied in together? Well, because a mortgage loan is an amortizing loan or amortized loan. And what that means is that even though the amount of principal versus interest that you pay every month differ, one payment amount is calculated. So you make just one payment. There's one fixed amount that you pay, and that is if it's a fixed loan, fixed interest rate, that is, which most people have. You make one payment, and within that payment, with each month, the calculation is done in such a way that the principal and the interest change within that single payment, and yet at the same time, at the end of the term of the loan, whether it's a 15-year loan or a 30-year loan, at the end of it, you would have effectively paid all the required interest and all the required principal so that your loan is down to completely zero at the end of the term. So it's an amortizing loan, and within that single payment that you make is your principal and your interest. So those are the first two items that go into your mortgage payment. And again, if you have a fixed interest rate, that payment will stay the same for the entire term of your loan. The third item is your mortgage insurance. Depending on the type of loan that you got, there are different mortgage insurance requirements for differing loans. And so it's possible that you even got a loan that does not require mortgage insurance. And if that's the case, you will not have this third item included in your mortgage payment. There are some loans where the mortgage insurance falls off after a certain number of years. If that's the case, after those years have passed, then your mortgage payment will come down because the mortgage insurance will come off. But generally, if you have a loan that requires mortgage insurance, that would be the third item that you add onto the principal and interest that add into to make up your mortgage payment. The fourth and fifth items are your escrow payments. The fourth would be your property taxes. So your property taxes from the year before will be divided by 12 and added as a payment or added as part of your mortgage payment. And that's because for the term escrow, it means the bank is escrowing or holding on to that money for you as you make that payment every month. They add up the year's payment and then they pay your property taxes for you. So the fourth payment or the fourth part of your mortgage payment on there would be your property taxes. And that is calculated on a yearly basis and added to your mortgage. The fifth item is also escrowed, which is your homeowner's insurance. That is also taken and added in. It's the yearly amount is taken, divided by 12, and added as your mortgage payment. Those are the five items that go in to make up your mortgage payment. So can your mortgage payment change? Yes, it can. Now, these are the items that can change. If you have a fixed interest rate loan, then your principal and interest, the first two items, those cannot change. For the entire term of the mortgage, they do not change. The third item, your mortgage insurance, that can change. Again, like I said, depending on the type of loan that you had, it could be one that the mortgage insurance falls off after a certain number of years. That would be great. So that would bring your mortgage payment down. The fourth and fifth items are the ones that do kind of change constantly because your property taxes and your homeowner's insurance are they're not things that are under the control of your mortgage bank. So your property taxes are set, by your county, and as they change, as they fluctuate up or down, the bank has to adjust how much they collect to put into your escrow account. So that could either raise or lower your mortgage payment. So you want to keep track of what your property taxes are every year, because just by looking at them you can see if your mortgage payment will be going slightly up or coming slightly down. It's important to note for the folks who like to make their automatic payments simply by setting it up in the bank and sending one single payment to the bank. Make a note, because sometimes your mortgage payment will go up because of the change in your property taxes, and if you're just sending the same amount, you might be deficient on how much you're sending into the bank for your mortgage payment. The same thing applies for the homeowner's insurance. At renewal, if your homeowner's insurance goes up, the bank has to adjust and collect more in your mortgage payment for the next year. So make sure that you are paying attention to when your homeowner's insurance renews, because typically the homeowner's insurance company just sends a new bill to the mortgage company. You may or may not see it. The mortgage company gets it, adjusts the payment accordingly, and goes on. So you need to look and see if your home insurance payment is just continually going up. You may need to shop for other home insurance. You can do that. It's in your control. The bank will take whatever insurance policy you bring to them, as long as it meets the requirements of the mortgage to cover the home that you have that has the mortgage note on it. They will accept that. So if your homeowner's insurance is going up, you may want to shop with other carriers and make sure that you have the best price there to also help bring your mortgage payment down. So those are the items that can cause your mortgage payment to either go up, which is usually the case, or sometimes come down. I'd like to mention one other item. That is your homeowners association. Now, in a previous video, we talked about your debt to income ratio and how that is the calculation that is done to see how much of a mortgage payment that you can afford when the bank is qualifying you for how much of a house you can buy, or how large of a mortgage you can get. In the debt to income calculation, it singles out how much your mortgage payment can be. We went over the 5 things that go into your mortgage payment, but in the debt to income ratio calculation, there is one other item that's added, which is your homeowners association dues. Those are not part of your mortgage. You don't pay those with your mortgage. The bank doesn't collect those. You pay those on your own. But in the debt to income calculation, that payment is added. So let's say you had $2,000 was what you could use for your mortgage payment. Well, the homeowners association is added to those 5 items that we went over in this video in order to qualify you for that amount. So your homeowners association must also fit within that $2,000 in order for you to qualify. So that's important to know, that is taken into consideration, by the bank. So that's a quick summary on what goes into your mortgage payment, with a little addition there of if you're working on your debt to income ratio, that the homeowners association fees are added. Again, if it's usually homeowners association fees are paid yearly, but we do divide that by 12 and add that as part of the payment that's calculated in the debt to income ratio. If you have any questions on anything we've talked about here today, please leave them in the comments below. We'll be happy to answer those for you. Please hit the like button for the video if you liked what we talked about, and also do subscribe so that you can see what other videos we have coming out. Until the next time, keep doing everything it takes to get yourself prepared for that awesome mortgage.